Balance sheet. Think of the balance sheet as a financial snapshot of a company at a specific point in time. It's divided into three main sections: assets, liabilities, and owner's equity. Assets are what the company owns, like cash, inventory, and property. Liabilities are what the company owes, such as loans and accounts payable. And owner's equity represents the portion of the company that belongs to its owners. Overall, the balance sheet serves as a fundamental tool for understanding a company's financial standing and making informed decisions about its future. Profit and loss statement, also known as the income statement. This statement provides a summary of a company's revenues, expenses, and profits or losses over a specific period, typically a month, quarter, or year. It's like a report card for the company's financial performance. Cash flow statement. This statement tracks the flow of cash into and out of a company over a specific period. It's divided into three sections: operating activities, investing activities, and financing activities. The cash flow statement helps investors understand how a company generates and uses cash. Owner's equity statement. This statement shows the changes in the owner's equity of a company over a specific period. It includes items like dividends paid to shareholders and any changes in the company's capital structure. It is basically how much equity an owner has in the company at a certain time. Financial budget. This refers to a financial plan that outlines expected income and expenditures over a specific period, typically a fiscal year. It serves as a roadmap for managing and allocating financial resources within an organization or for an individual. By ensuring the company is within budget throughout the year, you will be able to meet the expected results. Midterm plan. Similar to the financial budget, a midterm plan is a roadmap that outlines goals and objectives to be achieved, but rather than a fiscal year, it is typically within a medium-term time frame, usually spanning 2 to 5 years. Stock. This represents ownership in a corporation and entitles the owner to a share of the company's profits and assets. Earnings per share, or EPS. This is a key metric used to measure a company's profitability on a per-share basis. It's calculated by dividing the company's net income by the total number of outstanding shares of stock. EPS provides a simple and standardized way to assess a company's profitability per share, making it a valuable tool for investors and analysts in decision-making processes. Asset allocation. This refers to the strategy of diversifying your investments across different asset classes, like stocks, bonds, and cash, to manage risk and optimize returns. Remember, don't put all your eggs in one basket. Compound interest. This is interest calculated on the initial principal amount and also on the accumulated interest from previous periods. It's like earning interest on top of interest, a powerful wealth-building tool. Dividend. This is a portion of a company's earnings that is distributed to its shareholders as a reward for owning the stock. It's like getting a slice of the company's profits. ETF, short for exchange-traded fund. An ETF is like a basket of different investments, stocks, bonds, or commodities, bundled together into a single tradable security. It's commonly used for long-term investing, as well as for short-term trading strategies. Inflation. This is the rate at which the general level of prices for goods and services is rising, weakening the purchasing power of money over time, which is why investing your money is crucial for it to hold its value at the very least. As your money sits in the form of cash, it slowly loses its value due to the ongoing inflating prices. Liquidity. This refers to how easily an asset can be converted into cash without affecting its market price. Cash is the most liquid asset, while real estate may take longer to convert into cash. Market capitalization, often referred to as market cap, is a measure used in finance to evaluate the size and value of a publicly traded company. It's calculated by multiplying the current market price of a company's outstanding shares by the total number of outstanding shares. Mutual fund. This is a professionally managed investment fund that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Net worth. This is the difference between a person's assets and liabilities, representing their overall financial health and wealth. Options. This is a contract that gives the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price before or on a specified date. In simple terms, you might use options because they give you the opportunity to make money or protect yourself from losses in the stock market without needing to invest a lot of money upfront. Although options offer flexibility and leverage, they also involve risks. Options trading requires a good understanding of the underlying assets, market conditions, and option pricing dynamics. Portfolio. This is a collection of investments owned by an individual or institution, which may include stocks, bonds, mutual funds, and other assets. Risk management. This is the process of identifying, assessing, and mitigating risks to protect against potential losses. It's like having a safety net for your investments. Tax deduction. This is an expense that reduces the amount of income subject to tax. It's like getting a discount on your taxable income. Volatility. This refers to the degree of variation in the price of a financial instrument over time. High volatility means prices are fluctuating widely, while low volatility means prices are relatively stable. Yield. This is the income return on an investment, such as interest or dividends, expressed as a percentage of the investment's cost. It's like the annual interest rate you earn on your investment. ROI, or return on investment. This is a performance measure used to evaluate the efficiency or profitability of an investment. It is calculated by dividing the net profit generated from an investment by the initial cost of the investment, and then expressing the result as a percentage, basically telling you if you will make your money back or not from this investment. If you made it this far, truly, thank you for your support on my first video.